So can I just first of all welcome everyone to today's webinar. Probably going to start doing this more often actually, because I think it could be beneficial to everybody just to understand what's really going on in the markets at the moment. So my name's Kayan. I run PipCountFX. Don't know if many of you've come from my free analyst channel I started on Telegram, just explaining to everyone what's going on in the markets at the moment. So what I'm going to do today is I'm going to be running through what's happening right now in the markets, what we can expect moving forward, how we actually use economic data to analyze trading opportunities by paying attention to the fundamentals driving price. And then once we get an idea as to what's happening at the moment and the fundamentals that we use to get trade ideas, then you guys will, by the end of this, have a much better understanding of the opportunities in the market and how we are presented with these opportunities by really understanding macroeconomics, the type of stuff you would learn if you studied economics and finance, and then why, once you understand this, you will then see through a lot of the nonsense that people are taught in terms of trying to trade technicals, and you will start to see how you use that in conjunction with fundamental analysis to try to get into the market, out the market, and try to make some money, which is the whole point of trying to invest. So for an example, just to start off what we're seeing at the moment in the market. So what I'm going to do is I'm going to run through what we are seeing in the oil markets at the moment, how this is affecting the commodity currencies in the markets, and then I'm going to start to break down how we analyze economic data to even identify these opportunities in the future, and of course how we can generate really professional trade ideas and be on the right side of the market instead of being on the wrong side. So what we're going to do now is I'm just going to explain to you oil prices and why we've seen such a drop in oil prices over the past few weeks. So as you guys are aware, we've had this outbreak of this virus in China, this coronavirus, which has now infected over 20,000 people. There's been around 500 deaths in China, and oil prices have slumped by 20% in the past few weeks. So of course, that's a big drop for a major commodity. But what we need to understand is, why did this commodity drop? What was the fundamentals causing this commodity price to really depreciate? And then you will now in the future know how to identify opportunities with commodity currencies when this happens again, or maybe even just selling oil itself if there is ever a natural disaster or some sort of virus epidemic in China again. So the first thing we need to analyze and get a major understanding of is the crude petroleum export markets. So we have many countries that export oil. That's plain to see. There's many commodity currencies in the world, like the Russian ruble, the Canadian dollar, for an example. But it's the importers who is buying oil is such a major driver for oil, because you have a supply and you have a demand for oil. So if oil is being supplied to the market by the producers, that has an effect on the price. And then you have the demand equation from who is buying oil that also has an effect on the price. So for an example, if supply is being cut and you have a high demand, prices rise, and vice versa. If there's a low demand and an increased supply, prices fall. So it's pretty simple to understand what drives oil prices in terms of supply and demand. But what we've seen is, we've seen China, which buys 18% of the world's crude oil, slowing in growth because of this outbreak in China. And many of the major cities are in lockdown across China. And this means that the biggest consumer of oil is now reducing how much oil they're going to be importing, because machinery, petrol stations are going to be closed. Factories that use oil to run are going to be ordering less imports of oil because they're being shut down, because everyone's trying to stay away from everybody else and to try not to catch this outbreak of this virus. And then, as you see here, oil prices slump on this news about all these major cities in China slowing, because that is very, of course, damaging for the demand of oil if you have the biggest oil importer in the world slowing in growth. So, of course, we can understand why that has a big impact on the commodity because of the demand equation. But then we need to understand, why are these currencies like the Russian ruble, the Canadian dollar, the Norwegian krona, and the Brazilian real, why are these currencies so affected? And what we need to start to understand is, when we start to build what we call an endogenous analysis on a currency, we need to understand what causes a country's currency to be in high demand. And this is how you can generate really high quality trade ideas, once you understand what a country is selling to the rest of the world. Because you need to understand an exchange rate between the US dollar and the Russian ruble is really money flowing between Russia to the United States, or the United States into Russia. So, of course, if one country is selling a major export like oil to another country, if the demand for that commodity export goes down, then there's less money coming into Russia, for an example, and then the Russian ruble is in less demand, so you'd have more Russian rubles going into the United States to pay for US exports than US dollars going into Russia to pay for oil exports. Hence why you get a rise in the dollar when you have oil prices slumping. And then you can see previously, when you had oil prices rising in 2019, you had a stronger Russian ruble against the US dollar. So you can see the Russian ruble is a base currency here. So when it's going down, the Russian ruble is getting stronger. And when it's going up, the US dollar is getting stronger. So what we need to do is, we just need to understand what is Russia's exports. And if we look, we can clearly see that oil makes up nearly 46% of all of Russia's exports. So crude petroleum oil prices is going to have a massive impact on the demand for the currency in the markets. And then we need to look at, well, who does Russia sell their oil to? And when we come down here, we can clearly see that they're selling 11% of their oil is going to China. So you can clearly see that China is Russia's biggest export market for their oil, which is their biggest export. So clearly we can understand that if China's economy is slowing and there's less oil demand, that automatically hits Russia's currency. Hence why we see the currency weaken in the exchange rate by around 5%. And that's 3,000 points or pips. And as you know, when you're trading the currency markets, for each pip the exchange rate moves, you make money. So if you're making 3,000 pips, you can start to see how it can add up, and you can make some profits in the markets. Now, this is not just the Russian ruble that we are seeing this oil price affect. If you move across and we have a look at the Norwegian krona, so Norway, what is Norway's main exports? Oil, as we can clearly see, 26%, and 26% of their exports is gas. So if Norway's exports of oil is falling, if their main export, if the price of their main export is falling, then that's going to have a damaging impact on the price of their currency. So hence why, if you look at the Russian ruble, the Norwegian krona, we see the exact same situation. We've seen, look how much we've seen the Norwegian krona weaken against the US dollar as oil prices have slumped in the markets. And previously, when oil prices were rising in the markets, we had a stronger Norwegian krona against the US dollar. So clearly here again, you can see the cross relationship for the Norwegian krona and the price of oil, because the higher the price of oil goes, the more in demand the Norwegian krona is, the stronger it gets in an exchange rate. If oil prices are slumping, then that's going to have a negative impact on the value of the currency. And we also have the euro gaining strength against the Norwegian krona as oil prices are falling. So it's very important to understand that at this moment in time, whilst the oil price is low, the Norwegian krona gets hit by this lower oil price. If, for an example, this coronavirus, if the outlook looks more positive, so say the Chinese find a vaccine to stop the spreading of this virus and heal people, if they manage to contain this virus outbreak just to China, it doesn't spread globally, that could be positive. And if the markets believe that in the next 6 months they can deal with this and they can get back to normal, then we would have a situation where oil prices will rise, and then we'll be in a situation where you now have all the commodity currencies that are dependent on oil will strengthen again in the markets, and we get some opportunities to try to trade the rebound in oil prices. And then again, if you look at Canada, again, a commodity currency, it exports 14% of its major exports is oil. So you can see that's a big proportion of their exports. So clearly, again, if we look at the oil market, we see exactly the same situation playing out in the market. So let's have a look at the Canadian dollar, for an example, against the Japanese yen. And we've seen the Canadian dollar fall in the market. Currently, it went down by nearly 4%. That's a big drop in this exchange rate, hence why it was followed by, again, a weaker oil price. And when oil prices were rising, no surprise, we had a stronger Canadian dollar in the markets. So again, Canada is a commodity currency. And then we can look at currencies that are not dependent on the price of oil, but still are dependent on trade with China. So why has the Australian dollar got so weak, not just in the last 2 weeks, but since 2018? As I'm sure you've been aware, the US and China have had this whole trade war between the two countries, and that's really slowed Chinese growth, which was already kind of slowing anyway. But you can clearly see the exports of Australia is 20% iron ore and 19% coal. So they're the two biggest exports for Australia. We can clearly see that China buys 35% of all of Australia's exports. So that's their major trading partner. And if we even have a look just to see where China's exporting the iron ore to, which is their major export, then we can get an even deeper picture towards Australia and their currency. And you can clearly see that when this pops up, you're going to see over 82% of their major export goes to China. So now you can start to see and understand why the Aussie dollar has sunk in the markets at the same time. Now, this is a trend not just seen in the last few weeks. If we zoom out and we look at the bigger picture, since the trade war between the US and China started in 2018, what has happened to the Aussie dollar? It has sunk in the markets because investors know that this means that if China's economy is slowing and they're reducing their trade with Australia, then that means less money is coming into Australia. There's a less demand for the currency. That's going to have an impact on inflation. So the demand for all the exports that are coming out of Australia, there'll be lower levels of employment, for an example, and you're going to have inflation moving away from the central bank's target. And this is why the Australian Central Bank has been cutting interest rates in Australia over the past year to try to support the economy and weaken the currency in the exchange rate purposefully to help their exports remain competitive. So now you're starting to get an understanding of how these commodity currencies are so reliant on trade with China, or their main export oil has such a strong correlation to China because China is the biggest importer of oil. Or if you're a country like Australia, you can see that you highly rely on trade with China to purchase your exports. Hence why you see a weaker Aussie dollar against the Japanese yen, and you see the same situation playing out for the Aussie dollar against the US dollar since the trade war between the US and China started in 2018. So again, in the last few weeks, you've seen a huge sell-off in the Aussie dollar, but more importantly, this has been a big trend because of Chinese growth slowing and the demand for the Aussie dollar going lower, and this is reducing trade with the rest of the world for Australia. Then we have New Zealand, who is New Zealand's main exports market. Same situation. New Zealand's main export market, again, is China and Australia. So if China's buying 24% of all of New Zealand's exports and Australia's buying 15%, then if China's slowing, you automatically now know from the last analysis we just did that Australia is slowing. And if Australia is slowing and New Zealand is exporting 15% to Australia, then now this means that two of New Zealand's biggest export markets are now going to be affected because of China slowing. And then what do we see in the markets? We automatically see a weaker New Zealand dollar, when this starts to happen and we have negative news about the Chinese economy over the last week. But look at the bigger picture. Since the trade war started in 2018, no surprise, we've seen a weaker New Zealand dollar. So China is such an important component for many of these commodity currencies, and we must understand what is happening in these domestic economies, how they're so reliant on trade with China, because that is what is going to drive their currencies in the markets, and that's what's going to give you some trading opportunities when you start to understand this, and you can start to try to generate some trade ideas. So that's looking at New Zealand. I was looking at Australia, and now what we need to do is I want to show you how professional traders do an analysis of an economy to predict whether a country is going to be growing, expanding, or contracting. And then, of course, remember, central banks use interest rates to try to spur growth, inflation in a country, and even affect the value of the currency. Now, currency manipulation is so important for many central banks. That's why you hear Trump calling China a currency manipulator, because, say, for an example, you have a country like Australia selling iron ore to China. Remember, all commodities are sold in US dollars. So let's say, for an example, the price of iron ore is falling because China's demand for iron ore is going lower, because let's say China's economy is struggling. If the price of iron ore is falling and the Aussie dollar, remember, their exports are sold in US dollars because all commodities are sold in US dollars. If the price of iron ore is falling and the Aussie dollar doesn't devalue against the US dollar, what do you think that means? That means you have an export that's in lower demand, so you're making less money because the price of your export's going lower. And unless you devalue your currency against the US dollar, that's going to mean that you're making less money for your commodity that's now dropping in price, and the purchases of your exports are going to be receiving less because the exchange rate is not devaluing. So if you keep the Aussie dollar strong against the US dollar, then that means you're making the importers who are buying your exports are receiving less and you're making less. So they have to devalue the Aussie dollar by lowering interest rates. And remember, interest rates drives the value of currencies. And if you haven't watched the video, I will suggest you go into my Telegram channel, and I posted this and I've done videos on this. You need to understand interest rates because it really does drive the value of a currency. And if we go up, you can clearly see here where I've posted 2 videos where I've shared this in intense detail with you guys, explaining how interest rates really drive the value of a currency. So you can come into the channel for free. You don't have to pay for it. I've been doing daily video analysis every day, explaining markets. You can come and join, but watch these 2 videos and you will start to see how interest rates have the biggest impact on the value of a currency. So how do we analyze an economy to understand what's going to happen with interest rates and what's going to then happen with the value of a currency? We have to do a thing called an endogenous analysis. So what this is basically doing is, when you are looking at the economic calendar, which I'm probably sure you're aware of, all this economic data comes out every day, and you probably don't understand what markets are paying attention to, what they're not paying attention to. Why does the ISM manufacturing, why is it such a big event in the markets? Or why is, for an example, exports data not that much of a big indicator in the markets that people pay attention to? So what we're going to do is I'm going to show you how you analyze economic data. I'm going to show you the process you go through. And then once you analyze an economy, you then have a view on the currency. And then we're going to build an exogenous analysis where we compare one country to another. And then we get an idea about a trade that we can take in an exchange rate based on the fundamentals and the economic data that's telling you whether a country is growing, expanding. The currency will be in higher demand because investors will want to buy the currency to invest in the stock market, or invest in the currency because of higher interest rates, or vice versa, where you have low growth, low inflation, lower interest rates, a weak stock market. People don't want to be investing in that country, and that currency is going to be in low demand, and that means that the currency will devalue when you have a central bank lowering interest rates. So we need to learn how to get to that point, to having a view And then once we get our view, we can start to look at things like technical analysis, where we look to time our fundamental trades. And then I'm going to show you guys why most people who try to trade technical analysis without even understanding the fundamentals, you can't do it. You can't make money. I don't care what no one says to me, because you don't understand why price is moving. And I'll give you a prime example when we look, for an example, at the oil prices at the moment. And if you was using technicals, why you would have been caught out and you would have actually lost money in the last week or so. So let's just have a look at how we analyze an economy. So what we're going to do is we're actually going to start by looking at one second. We're going to start by looking at the US economy, and we're going to build an idea as to what's happening in the United States now, what's predicted to happen in the future, and it's our predictions for the future that's going to generate some trade ideas towards the US dollar. Is the dollar going to be in high demand? Is the dollar going to strengthen, or is the dollar going to weaken? So you have three types of economic data you can study. You have leading economic indicators, which is telling you what's going to happen in the economy over the next 12 to 18 months, was predicting what's going to happen. You have coincident economic indicators, which is telling you what's happening in the economy now. And then you have lagging economic indicators, which is what the government and central bank are using in reaction to what the leading economic indicators are predicting, and what this the coincident economic indicators are telling us what's happening now. But just remember, a central bank and the government has two mandates: to maximize employment and have price inflation around 2%, so you keep the value of a currency stable, so prices between goods and services are not rapidly rising and people can't budget for their groceries, for their mortgage. So they have to keep the value of a currency stable, and they have to make sure people are in work. So they have to accept the policy for an economy to have maximum employment, steady inflation, and then that creates an environment where everybody has a job, everybody's satisfied, everybody's spending money, people are earning money, businesses are earning, people's wealth gets higher, you have strong levels of economic growth, and then hopefully that party gets re-elected for another 5 years or so. So the coincident economic indicators are telling us what's happening now in the economy. So this is inflation data. So CPI inflation data, producer price inflation data. So are the prices of goods and services going higher, and at what rate? That's going to tell us if the central bank's mandate is being achieved. Are they meeting their 2% inflation target, which is what many central banks have? And then we have employment data, which is telling us, do we have maximum employment? How many people are going into employment? So these are the coincident indicators which are telling us what's happening in the economy now. We have the leading economic indicators, which are our most important economic indicators. So if you're trading jobs reports like non-farm payroll and NFP or any employment data, you're trading the wrong way, because that's all that data is from the previous month. You're not predicting the future, and markets are always predicting what's going to happen. And that's why they're always pricing in the expectations, for an example, of interest rates to go up or down, so on and so forth. So we have leading economic indicators that are telling us what's going to happen in the next 12 to 18 months. And these economic indicators are going to be used by the central bank and the government to react to these indicators to make sure that in the next 12 to 18 months, you're going to have maximum employment and price inflation. So the leading economic indicators are ones we study. So we look at manufacturing services PMI. So this has an 85% certainty with predicting GDP growth. And you can see this here. You have manufacturing PMI in blue, and then you have GDP in red. Now look how closely they correlate each other. And this predicts GDP with an 85% certainty since 1950. Each and every time you have the ISM manufacturing going above the level of 50, this indicates growth. And when you have manufacturing going below 50, this indicates contraction in an economy. And you can clearly see when it goes into contraction, GDP goes into contraction. When it goes into growth, GDP is in growth. And when it goes into contraction, GDP comes into contraction, so on and so forth. So this is what we're looking at the US economy from ISM manufacturing. So markets use this data to predict in the next 12 to 18 months, if there's good readings above 50, we're predicting growth in the US economy. Same situation applies for the services sector in the US economy, which makes up 80% of spending, and only 20% is manufacturing. And again, this has a very strong correlation to GDP growth. And then we look at consumer sentiment, for an example, predicting what's going to happen in the next 12 to 18 months. And this is giving us an idea: are consumers bullish? Are they bearish? Are they confident? Are they negative towards their future economic prospects? And this will give us another trade idea in terms of, is an economy going to grow? Is it going to expand? Because if consumers are confident and we have businesses that are confident by looking at the business manufacturing PMI and the services PMI from the businesses, then we can start to have an idea that businesses are bullish, consumers are bullish, the economy is looking positive in the next 12 to 18 months. That's a positive sign for an economy. And then we look at other data like building permits. So how many building permits are being permitted in the United States? Are home developers bullish on home purchases? And if they are, then clearly people who are buying houses must have a confident outlook for their future, because buying a home is a big commitment. You have to borrow money from a bank. You have to do up your home. A mortgage is a responsibility you can't mess up on. So again, these leading economic indicators, which I'm showing you, predict what's going to be happening over the next 12 to 18 months. And we use like a scorecarding system where we score for inflationary conditions, so strong conditions from 0 to 10, or negative conditions from 0 to -10. So at the moment in the United States, we have positive conditions predicted over the next 12 to 18 months. So we have an inflationary score overall, which is basically showing that the United States is predicted to be growing over the next 12 to 18 months. And then that idea of understanding that, then we know that we should have good levels of employment and we should have good levels of price inflation. So every month we just take these economic indicators, we plug them in to our spreadsheets. We do in-depth analysis, understanding what's happening. So with interest rates, for an example, on a month-to-month basis, this is the same way that professional traders are analyzing markets, using these same spreadsheets, using the same scorecarding system before they generate a trade idea towards the currency. So you get inflation, for an example, you look at employment, for an example, you look at government spending to understand, is the government trying to create an inflationary environment in the economy? And what we do is we then come to a final bias to how committed we are looking at the US economy. So we have a score right now of 26, which is quite good for the US when you compare this to all the other countries at the moment. So the US is in quite an inflationary condition compared to many of the other economies in the world at the moment. So then, of course, if we have quite a strong view on the US, we then obviously have to do the same for Australia. If, for an example, I wanted to trade the US dollar, Aussie dollar exchange rate, and we've done exactly the same analysis for Australia, but Australia's outlook is not as positive. But remember why I told you at the beginning of the video, China's been slowing. I showed you how much the Aussie dollar's been getting weaker because China's economy slowing has a negative impact on Australia. So when we look at Australia's leading economic indicators, which is predicting what's going to happen in Australia over the next 12 to 18 months, what do we have? We have negative scores. So we have deflationary conditions. If you have deflationary conditions being predicted over the next over the next 12 to 18 months, that's not positive. More likely the central bank's going to have to lower interest rates to try to spur growth, try to devalue the purchasing power of the Aussie dollar against other currencies and exchange rate, make the exports more cheaper, help more money flood into Australia and help growth. But again, we understand that lower interest rates is negative for the currency. So at the moment, we have a deflationary score below 0. So this is showing you that the situation in Australia right now is not positive. And this is what is reflected when we look at, of course, the Aussie dollar, US dollar exchange rate, which we looked at before. We've seen this now reflected in the price of the Aussie dollar since 2018. China's been slowing. We saw that China's buying 82% of their major exports. 35% of everything goes to China. Now we have a better idea as to why the Australian economy hasn't been looking so positive at the moment. And look, we have negative inflation conditions right now. Remember, The Australian central bank and government has a mandate to maximize employment and keep inflation at 2%. At the moment, we've got deflationary conditions in the economy, negative predictions moving forward. That's not positive for the Aussie dollar. So what we then do is we build an exogenous analysis where we do a comparison of Australia to the United States. So we look at relative growth, for an example. We look at relative GDP. We look at balance of payments, where money's coming in and out of the economy. And we actually do a deep analysis on the major exports itself to get a good idea as to when we want to be buying the Aussie dollar against the US dollar, for an example. So we look at iron ore prices historically, for an example, in depth, and then we get a better understanding. And then what this basically does at the end is we then add up our total scores. So we add up our US total endogenous score, our negative Australian total score, and then we clearly see that we have a final score that we definitely want to be buying the US dollar against the Aussie dollar, because look, we have a score of 24 compared to Australia's negative score of 3. Hence why the Aussie dollar is getting weaker in the market. So everything I've just shown you is everything that the markets are doing. And this is why if I take you to this website, the ASX.com, you will see how the markets, more importantly, you will start to see why the markets at the moment are betting that the Australian Central Bank is going to lower interest rates to 0.5%. So again, they're going to cut interest rates by around September of this year. If the economic conditions, which are being predicted, which I just showed you, if these are correct and it is predicting a slowdown over the next 12 to 18 months, then this is why the markets are pricing in a rate cut expectation. So that's how we generate trade ideas, traders. This is the process we go through. So once we now have this idea, I want to be selling the Aussie dollar against the US dollar. I basically want to be investing in the US dollar and not in the Aussie dollar in that Pacific exchange rate. Then what we do is we start to use timing strategies to get into the market. So we look at a thing called COT reports. And this is basically telling you how committed the professional market is towards buying a currency in the market. So for an example, each Friday, there's a commitment of traders report, which is released. And this report is basically telling you how committed the market is towards buying the Aussie dollar. So how many future contracts that are being bought for buying the Aussie dollar and how many contracts are being bought for selling the Aussie dollar in the markets. And what you can clearly see is that when you have the net amount of contracts which are showing there's negative contracts are outweighing positive contracts and it goes below 0, you can clearly see here that the green represents the Aussie dollar US dollar exchange rate, as you can clearly see here. And when we get a flip below 0, you see the exchange rate sink and you see markets are now fully committed towards selling the Aussie dollar, and there's no surprise why the exchange rate goes lower. And then once you have more positive contracts towards the Aussie dollar than you have negative, you get the Aussie dollar US dollar exchange rate rising in the markets. And basically you are using the professional market to tell you when to buy or sell the Aussie dollar US dollar exchange rate, for an example. And we do that for all the currencies. So if you can see along the bottom, we've done this analysis for many of the currency pairs. And then once we have done that analysis and we get an idea for how committed the market is, we then monitor the prices of an exchange rate on a week by week basis to understand if a trend is starting to develop in our favor. And then once we get a better idea if we have consistent weeks of negative red weeks where for example, the Aussie dollar is going lower against the US dollar week on week on week, now we know, number one, we have a bias towards selling the currency pair. Number two, we now know the market's committed from the COT reports. Number three, price action is telling us every week it's now moving in our favor. And then what we then do is we then move over to technical analysis strategies where we look to get into the market and try to time our fundamental trade idea. And that's what technical analysis is for. So for an example, if you had the bias to sell the Aussie dollar, US dollar, and you had a trend line forming where you kept seeing lower lows and lower highs forming. Once we've done our fundamental analysis, then we use the technicals to bet, okay, this is a good time to get in. This is a good time to trade. And for an example, you may have traded the third bounce on this trend line and sold, and then you could have sold the trend line bounce again, for an example, sold this breakthrough for a support level. You could have traded the whole trend all the way down. And remember, at the same time, whilst you'd have been trading that currency pair, you would have been analyzing the Australian economy outlook, and you would have kept seeing the outlook getting worse and worse, and then your commitment towards selling the currency pair would have got stronger and stronger, and then you would have had a good trade for the Aussie dollar, US dollar. So traders, this is important, because what we need to do is, when we're building and using these spreadsheets, what we're doing is we're analyzing data the professional way. We're getting an idea of when it's a good time to buy a currency pair, when it's a good time to sell a currency pair by doing this whole entire analysis. And then we're using our economic analysis to generate a trade idea, and then we're going to get in the markets and try to trade it. So if you are, for an example, only trading technical analysis and thinking that you're going to get a good trade, I'll give you an example why you can't do that. Because the markets are using the leading economic indicators I was showing you to predict what's going to happen, and then they start to price into the value of the currency what is being predicted to happen in the future. Hence why you see a long-term trend developing when the leading economic indicators are coming out in a certain way. So here's an example. If you're trading Japanese yen JPY, if you did not look at the news, if you did not understand the trade analysis I showed you about the Canadian dollar and their main export being oil, if you did not understand that, and this week, for an example, you saw the Canadian dollar Japanese yen exchange rate dropping in the markets, and you thought this is a good time to buy because I have a technical analysis trend line set up, you'd have just lost money straight away, because you didn't understand why the Canadian dollar is falling in value. Now, everything that moves in the market is dropping for a reason. There's a fundamental reason. And when it comes to currencies, it's the economy that is the reason why the value of a currency is rising or falling. Because if a country is doing good, if their exports are in high demand, if there's lots of money coming into a country, the currency is in high demand, and then you get a stronger currency in an exchange rate. And you get a situation where the economy starts to really expand and grow. You get inflation growing, employment growing, and then you're likely to have a central bank having to raise interest rates to try to contain inflation. And then what happens to the current currency? It gains even more strength in the markets. Vice versa applies to weak growth, weak inflation, weak levels of exports. Hence why you see the Canadian dollar weaken the moment their major export falls in value, because the currency will be in less demand. That can start to have an impact on employment, have an impact on inflation, impact on GDP growth. And then you get the bigger picture, what the central bank would likely do after a long time. They would cut interest rates to try to manipulate the value of the Canadian dollar lower to help their major exports become more competitive and cheaper, and help growth come back in the markets, and then the currency will weaken. So that's so important for us to understand. Now, if that makes sense, which it should do, then you now know you're not going to be ever looking at a trading chart without even understanding what the hell is going on. You will not even attempt to place a trade if you do not understand what's going on fundamentally, because you now know you're just completely gambling blindly and you don't even know what you're doing, and you're just basically chasing past price action, which is what a chart basically is telling you. This is the past. So each day, when you see the exchange rate moving, it's moving based on what the leading economic indicators are predicting is going to happen, and the market is pricing in this prediction into the value of the currency. That's pretty much what's happening. So that's important. Now, at the moment, if you're looking at the markets, the US dollar, the outlook for the dollar is positive. So we expect this long-term trend, for an example, to continue in the markets, okay? Because the situation in the United States is positive. We have a situation where the Great British Pound is expected to continue to rise if the UK and the EU can agree on a trade deal, because the UK has been suffering because of the uncertainty around Brexit. If they get a deal, money is going to flood back into the United Kingdom because it's one of the best places to invest. And before the 2016 referendum, the UK was one of the top places where capital was flooding into the UK because it's a business-friendly environment. And if that is a situation, then you understand good levels of growth, the currency becomes in high demand, and we get a stronger British pound. Now, if you understand about the Japanese yen, I can just show you two things that will make you understand why you never want to be buying the yen or the Swiss franc ever in the markets unless their leading economic indicators start to predict there's going to be some level of inflation. Because at the moment in Japan, negative interest rates below zero. Watch the videos in the channel I showed you at the beginning in my free trading channel on Telegram. And as soon as you understand why negative interest rates make a currency very unattractive and inflation's extremely low, below the central bank's 2% target, now you know the central bank is very unlikely at any moment going to be raising interest rates until they get to 2% inflation. Same situation in Switzerland, negative interest rates, low levels of inflation. So that means that we know interest rates are remaining low. So unless there's risk-off sentiment in the markets, and again, if you want to understand what risk-off sentiment is and why the yen and the Swiss franc are in high demand, go into the trading channel for free. I've done a whole video explaining it in the markets. So what does this basically mean? This means that when you get these moves against the Japanese yen, in the yen's favor, I am 10 times more committed to buying back these currencies against the yen the moment the oil markets start to recover, because I know that investors are not buying the yen for any fundamental reason. Low inflation, low negative interest rates. You lose money overnight if you buy the yen against a currency with a higher interest rate. So the moment the outlook becomes more positive, you know money's going to reverse, come straight out of the Japanese yen, back into the other currencies, and we get these moves higher that we are predicting will happen. It will definitely happen. It's just a matter of time in the markets. So the yen and the Swiss franc, again, we may be seeing strength right now because of these risk-off moves. But again, all this selling we've seen in the last few weeks is going to reverse, and it's already started, which we can see with the Aussie dollar, Swiss franc. And again, some really good trading opportunities coming up in the markets. So what are we going to do with, for an example, the Aussie dollar? Again, pay attention to what's happening with this coronavirus. Can they get this under control? Same for New Zealand. Can they get the coronavirus under control? Same for the Canadian dollar. And then we'll likely see a rebound in these currencies. But again, for Australia and New Zealand, we've got to be watching the leading economic indicator because they're not really that positive at the moment. So unless China can recover, unless growth can really recover globally, that would be a condition where Australia and New Zealand can recover. So traders, really interesting what's going on in the markets right now. One thing I did want to show you guys also is that I have just released my 2 courses, online courses, and I also offer one-to-one courses in person, or you can go have a look at my online courses. And these courses are in depth, basically explaining everything I've gone over with you guys today. So we're looking at how to break down economic data. If you're a beginner, you've never traded before, I've literally run over the markets in detail from a very beginner to being an advanced trader. So we have so much video material for you guys to give you the education to get to the level where you can analyze this economic data, which is amazing. And then we have extra videos as well, bonuses, which I will always keep updating for anybody who's taken the course, which is fantastic. And then if maybe you are new to trading or you've never traded before, you're not really sure if this is something you would be interested in, I did create an intermediate course, which is actually 50% of the beginners of the advanced course. And basically in the intermediate course, you would understand everything you would need to know towards whether you would want to be taking trading seriously. So this again is giving you a ton of videos in the course, breaking everything down. And once you have taken this beginner's intermediate course, you would then know whether you'd want to commit yourself to trading an advanced course and learning. So when you do take the course, traders, the most important thing to understand, you have a support team available at all times, including 6 months mentoring from me personally if you take the advanced course, and you have a support team available to answer your questions at any moment. Once you've taken the courses, you also get spreadsheets with all the economic data And you can also receive these spreadsheets, which are updated by me every single week or every single day, to be honest with you, in the markets. And it's something that you guys will probably want to do if you do want to take trading seriously. Maybe even trying to trade technicals doesn't work, and now maybe this would have opened your eyes to what really constitutes to trying to trade professionally in the currency markets. So guys, if you have any questions, I'll be happy to answer any of your questions quickly. So please go ahead. If you have any questions, go ahead, ask me. I'll be happy to answer your questions and try to reply to you guys. Yeah, go ahead, guys. Shoot away. Ask me anything you want. Yes, yes, you can rewatch this webinar. I'm going to post it on my YouTube channel tonight. So yeah, it will be up and available for you guys. Anybody else got a question? Oh, prices for the courses. Yes, of course. Sorry. So prices for the courses. So if you want to take the intermediate beginners course, that is $359. If you want to take the advanced course, it is £1,000 for the course. So do you think the whole situation in the US about the S&P 500? Well, if you understand stock markets, at the moment, the US leading economic indicators this week actually came out really positive, and we have ISM manufacturing and we have services and manufacturing, which are the two leading economic indicators that predict growth with an 85% certainty, peaked above 50. And there's no surprise that when it peaked above 50, what did you see in the markets, in the stock markets? You saw the S&P 500 rising higher at the same time. So see, look how high the US stock market has jumped. And this is because of the leading economic indicators I've been explaining came out this week. They both came out positive. They both now predicted that there's going to be even more strong growth in the US over the next 12 to 18 months. And this is why the US stock market reversed higher. And that's why oil markets have had a little bounce higher as well, because if the US economy is growing, the global economy is growing, and that is positive for oil moving forward. Hence why the stock market has pushed higher at the same time. Okay, I'm going to show you one thing about using lower time frames, why you're never going to use a lower time frame. Okay. There's something called volatility analysis, which is so important to a trader. So you have to understand historically what an exchange rate, how much an exchange rate fluctuates by. So this is called an ATR analysis. And we do this when you take my advanced course, and you learn it in the intermediate course as well, actually, tell a lie. And this is very important because what this is basically doing is it's telling you historically, when you analyze, for an example, the Canadian dollar against the Japanese yen, historically, what is the average volatility of the Aussie dollar, the Canadian dollar, Japanese yen exchange rate going back 10 years from 2009, and we're now in 2020, so nearly 11 years. And we can clearly see that when we analyze this data, the the Canadian dollar, Japanese yen exchange rate fluctuates by 0.67% on average on a daily basis going back 10 years. Okay, when you look at a daily analysis going back 24 days, you pretty much get to the same answer, so around 0.67%. If we look at a weekly chart, if we look at weekly time frames, on a weekly basis, the exchange rate fluctuates by around 1.6%. If you look at a monthly exchange rate, we can see that an exchange rate fluctuates by 3%. So as an investor, what do you think is the most important time frame you want to be paying attention to? We don't want to be trading daily time frames, because if it moves by 0.67% and I get up the Canadian dollar, Japanese yen exchange rate, and I look for a move of 0.67%, then I know that I'm looking to catch in one day 55 pips. Now let's use a strategy called risk to reward, which you have to do. If you're aiming, if your take profit is 55 pips, that at least has to be 3 times greater than your stop loss, because otherwise, if you kept getting stopped, if you won a trade and lost a trade, there was your winnings would never be able to continuously outgrow your losses. So, for example, if I'm risking £1,000 on a trade, I need to aim to make £3,000 if it hits my take profit, because if it does hit my take profit and I make £3,000, if I do the same strategy 3 times in a row, I would have to lose 3 trades in a row just to lose my previous winnings. You see? So if I win 3 trades in a row with a risk to reward of 3 to 1, now I have to lose 9 trades in a row just to lose my profits. But if you're taking trades in the market where the average daily volatility is 0.67%, we can clearly see this happens pretty much every day. So you could get stopped out straight away if your stop loss is only, what's 50 divided by 3? I don't know, let's say 15 pips. You could lose 15 pips in about 10 minutes. Hence why we have to trade over higher time frames. So we look to trade over 1 to 3 months with a 1 to 3 month risk to reward ratio, so we can catch the volatility that shows us that they're the time frames that give us the most moves. So let's say we're looking at the Canadian dollar, Japanese yen over a monthly time frame. 3.3% is how much it moves. Then if that's how much that currency pair moves, then I'm more interested in trading this move of 3.3% because I'm gonna get a bigger move in the markets. And what this is basically telling me is this: if the average volatility is 3.3%, this is how far my stop loss has to be. If I'm entering the market now, my stop loss has to be 3.3% because this is the average volatility over a 1 month window. So I have to give the markets the historical room it takes to fluctuate during that monthly period so I don't hit my stop loss. And then my take profit is going to be 3 times bigger than my stop loss. So if I'm risking 200, if I'm risking basically 300 pips, I'm aiming to get 900 pips. And this is why I'm showing you the fundamental analysis you have to be doing, because it's the fundamental analysis which is going to give you the opportunity to catch these big moves in the market over a 3 month window. Because no technical strategy is going to give you that unless it's in conjunction with a fundamental strategy. So yeah, that's why I say you don't even pay attention to smaller time frames. It doesn't matter. You just need to understand what's happening with the fundamentals, and then you'll get a trade idea literally based off that. Yeah, so a scorecarding system basically is how you score each economic indicator, and it's how you then generate a final idea as to if an economy is generating inflation or deflation. So each economic indicator has a score of 0 to 10 in terms of the least inflationary to the most inflationary, and then we have a negative score of 0 to -10 from least deflationary to most deflationary. And for each economic indicator, we have a score when we use the data, and we use some strategies where we look at historical data to understand what's normal and what's abnormal. And then in the end, we add all our scores up to get a final endogenous analysis to, okay, how inflationary or deflationary is the US economy, or in our example, the Australian economy. And then from that understanding, we have a qualitative analysis as to whether the economy is growing or expanding, is expanding in growth or contracting in growth. And then if we have an expansionary policy, an expansionary economy, we're likely to get higher interest rates, stronger currency. If we have a deflationary condition in the economy, we're likely to get a weaker currency in the markets. Okay, guys, so thank you so much for joining. I hope you enjoyed it. I'm going to post this on my YouTube channel. But remember, guys, I'm actually going to offer a special deal tonight on anyone who actually wants to take my course. I'm going to offer you a 20% discount tonight. If you take it before 12 o'clock, you get 20% off. So instead of the advanced course costing £1,000, it costs you 800. And I'm going to offer you a 20% discount on the beginner's course also. So again, you can get a good discount of £72 on the beginner's course. So if you are interested, come off of this webinar and message me on Telegram, or you can send me, on Instagram, or you can send me a message on Telegram to PipCountTrading. And this will give you guys, this is the person you want to be contacting. And this will give you a direct link to have a conversation with me if you want to. But yeah, I'm going to give you guys a 20% discount, and you get 6 months mentoring with the advanced course, and you get a 24/7 support team, and you get the free analysis channel where each and every day I'm basically updating you guys on exactly what's happening in the markets throughout the trading day, so you know what's going on, and that will basically help you implement what you learn on the course in the first place. So that should be good. All right, guys, listen, I'm tired. I hope you had a good day. Thank you guys for joining. I will be doing this more often. Take care. Thank you.